I asked you in advance what these major mistakes are, and the first one that you listed is an interesting one: not taking enough risk. Uh, on a day like today, when the equity markets have declined so substantially, some people might be thanking their stars, Mrin, for not having taken that risk. But is that a bad thing?
So, good evening, Alex, and nice to be on your show. Yes, I think in the long term, as you said, these ups and downs are going to keep happening. Of course, some days you have larger ups and larger downs. But I think when you look at it more from a longer term basis, you really need to see how is your portfolio doing overall. So, for example, let us say that you have only 5% equity, and that's what the average is in India, right? 5 to 8%. And you have a majority of your portfolio invested in traditional investments, like, for example, fixed deposits or insurance schemes, which typically, let's say, give you like a 5% sort of a return. At the end of the day, your overall portfolio is essentially going to give you a very low return. So, the point that I'm trying to make is that we are very worried about how equities perform on a day-to-day basis. But the point is that if you only have a very low exposure to risk in your portfolio, it's not really going to have a big impact both ways, right? Positively or negatively, right? But in the long term, not taking enough risk is actually eating into your returns in a very big way, because you're not beating inflation and you're not growing your wealth.
So you've given us an example, which we are also playing up on the screen right now, which talks about equity returns, which on a long-term basis, I think it's safe to assume 12%. If anything, it's more than that if you invest it appropriately. And fixed deposits, as things stand right now, are still waiting. Mrin, incidentally, I was having a conversation with my dad this morning, and he's saying deposit rates haven't gone up yet, so we're all waiting for that to take place. Of course, it takes place with a lag, but it stands at 5.5% or thereabouts right now. So, could you explain the examples that you've given us?
Yeah, so if you have like a 5% exposure to equity and the balance in traditional investments, and assuming these returns of 12% per annum on equity and 5.5%, of course, on deposits, which is fully taxable, but let's just look at the pre-tax returns. You're looking at 5.83% on an overall weighted average basis, versus looking at a portfolio which is slightly higher in equity. Let's look at 25% equity. You're looking at a weighted average return of about 7.15% in that case, which clearly is also going to help you beat inflation in any case and help you grow your money. So long term average inflation in India is about 5.5, 6%, right? So in that sense, you really need to ensure that your overall portfolio is beating inflation. And the only way that you can do that is if you're going to take enough amount of risk in the portfolio to do so.
The second one that you've mentioned, and this clearly points out, right, even in portfolio C, which you mentioned, is 50-50, and people who are younger would be advised to take a higher allocation to equity for their longer term goals, and therefore, to your point where people sometimes don't take enough risk, this is very important, because I think people cut their teeth. Mrin, won't you agree, with fixed deposits or recurring deposits? They learn how to save that way, but they should evolve from that and look at instruments like equity. But the second point that you made is not investing in inflation beating investments. This is related to the previous point as well,
Yeah.
but how would you explain it?
So the first point, we talked about risk allocation in the overall portfolio. But even for specific goals, it's really important to look at what is the sort of inflation that's there for that goal. So for example, on child higher education, the inflation is clearly 10% and above, is around 10%, right? So obviously you need to look at investing in an instrument that's going to give you a return higher than that 10%. So just to give you an example, let us say you need 20 lakh rupees 10 year down the line, and you're assuming a 10% inflation. It actually means that you're going to need something like 32, 33 lakhs 10 years down the line. And if you're only going to be investing this in traditional investments, which is what most people do, they go out and buy a child plan, and the child plans actually give them very low returns between 4 and 5%. But even if you assume like a 6% return, you're only going to end up having 25 lakhs. So there is going to be a shortfall in the overall amount that you actually need if you're not going to invest into something that's beating the inflation for that particular goal, right? So you look at having the right amount of risk on an overall basis, and also for that goal you need to figure out where to invest to beat inflation.